In the customer payment section, you can add the credit terms and credit limit. If you leave these fields blank, QuickBooks will use the default terms set in the company setting. Now let me export the customer aging report and open it in Microsoft Excel. The customer aging report is very important. It shows how much money your customer owes you, how late the payment is. From this report, you can clearly see who is paying late, how long the delay has been, and whether the customer has crossed their credit limits. In short, this report helps you protect your cash. Let us take one customer as an example and understand how this report is built and how to use it. The customer name is Red Rocks. The report date is 30th June 2025. Let us break it down. In the current column, the amount is 0. In 1 to 30 days, the customer owes $239. In 31 to 60 days, nothing is due. In 61 to 90 days, they owe $60. In 91 days and over, they owe $70. So the total balance is $369. Now here is the important part. This customer has a credit period of 10 days. This means this customer must pay each invoice within 10 days from the invoice date, and he has a credit limit of $200. This means his total balance should never go above $200, whether they are within the credit period or no. But here is the problem. The major issue with QuickBooks is it doesn't enforce credit limits. In stronger accounting systems, you get warnings or even blocks when a customer goes beyond their allowed credit. In QuickBooks, you have to check these things manually, just like we are doing with this report. Now let us talk about the aging brackets. How are these dates range calculated? Start with the report date 30th June 2025, then go backward using the credit term and 30 days block. Here is how it works. First, subtract 10 days the credit term from the report date. 30th June minus 10 days is 20 June. So invoices from 20 June to 30th June fall into the current bucket. Now subtract one more day to start the next bucket. That gives us 19th June. Go back 30 more days. 19th June to 20 May is the 1 to 30 days overdue bucket. Subtract one more day, the 19th May, then subtract 30 days. 19th May to 19th April is the 31 to 60 days. Next, 18th April to 19th March, 61 to 90 days, and anything before 19th March goes into the 90 plus days bucket. So every bucket is calculated by going backward, first using the credit period, then creating 30 days blocks and subtracting 1 day before each range. Now let us analyze the balance for this customer. Current is $0, all good. 1 to 30 days, $239, they are getting late. 31 to 60 days is $0, that's okay. 61 to 90 days is $60, not good. Over 91 days, $70, this is a big concern. Total amount due is $369, but their credit limit is $200. So the question here is, who approved these extra sales? Also the $70 is overdue by more than 90 days. That is a serious warning sign. There could be several reasons. The customer did not record the invoice in their system, the customer has no plan to pay, or someone in your company stolen the goods and charged the customer. The customer already paid but the money never reached to your account. Someone stole the payment. Whenever invoices move out of the current bucket and fall into the 1 to 30 days overdue slab, your accountant should start strong follow-ups immediately. Ignoring this will hurt your cash flow and make reconciliations harder. For this customer, the $70 and $60 need serious follow-up. This money will not come on its own. It is all about cash, risk and control. So keep checking your aging reports regularly. Do not rely only on the system. QuickBooks will not stop you, but you can still stay in control. Like and follow for more simple, smart accounting tips.